Manufacturing cost calculations using fixed and variable costs. In other words, using the behavioral approach to cost instead of the general approach. As the level of production increases, the variable costs will increase proportionally, while the fixed costs remain constant, in other words, the same. From this, it follows that the unit cost of a product decreases as the number of units produced increases. This is illustrated in the following table. So, if we have 100 units produced of a product and assume the variable cost is 1,000 Rand, in other words, 10 Rand per unit, as 100 times 10 results in 1,000. Furthermore, we assume the fixed cost is 5,000 Rand, irrespective of how many units are produced. So therefore, the total manufacturing cost will now be the variable cost of 1,000 plus the fixed cost of 5,000, which will result in 6,000 Rand for 100 units. We have to divide the total manufacturing cost by the number of units to get the unit cost. So we will have to cancel 2 zeros here, so it's 60 Rand as a unit cost. Now let's increase the production level from 100 to 500 units. Now the variable cost will still be 10 Rand per unit. Remember, 100 times 10 is 1,000. So 500 times 10 is 5,000 Rand. The fixed cost will stay exactly the same. Remember, it doesn't matter how many units you produce, the fixed cost stays the same. So it's still 5,000 Rand. So to get the total manufacturing cost, again, we add the variable cost to the fixed cost and obtain 10,000 Rand. So now 10,000 divided by 500 results in a unit cost of 20 Rand. So we can see the unit cost drastically reduce as the number of units produced increase. Let's now double the production from 500 units to 1,000 units. The variable cost will be 10 Rand times 1,000, resulting in 10,000 Rand. Fixed costs stay the same irrespective of how many units are produced. So now 10,000 plus 5,000 gives a total manufacturing cost of 15,000. Divide that by 1,000 to now obtain a unit cost of 15 Rand. So we see the unit cost even reduce further as production increase more. From this table, we see that the variable cost per unit is constant. It was 10 Rand each time. 100 times 10 is 1,000, 500 times 10 is 5,000, 1,000 times 10 is 10,000. So, as illustrated, we just divided each time the variable cost by the number of units to obtain the constant value of 10 Rand. While the fixed cost per unit decreases as the level of production increases. So 5,000 divided by, if we produce 100 units, gives us 50 Rand fixed costs per unit. 5,000 if we divide 500, or if we produce 500 units, will give us 10 Rand per unit fixed costs. And then finally 5,000 divided by 1,000 gives us a 5 Rand fixed cost per unit. So we can see definitely the fixed cost per unit decrease as the number of units increase. So now let's focus on break-even analysis. Based on our previous discussion, it gives us the tools to discuss this in a coherent manner. So break-even analysis is used to determine the number of units of a product that needs to be produced and sold in order for the income generated from the sales to equal the cost of manufacturing. In other words, it's where we neither make a profit nor a loss. We just break even. At this point, the business will neither make a profit nor suffer a loss. The business is said to break even at this point. This point is therefore known as the break-even point. So we can think of it as a seesaw, where the income from sales balances with the manufacturing cost. They both have the same weight. Following steps must be followed to calculate the break-even point. Step 1, we need to calculate the total fixed costs. This is the total fixed cost. This amount will not change if more or less units are produced. Step 2, we have to calculate the selling price per unit and the variable cost per unit. So take note, the first one is not per unit, it's the total fixed cost. In the second step, we need the selling price per unit and the variable cost per unit. So this is not the total sales and variable cost, but the cost per unit. Thirdly, calculate the contribution per unit. The key here is the second step. This is the amount per unit that is contributed towards covering the total fixed cost. So it will actually be the contribution per unit is actually the selling price per unit minus the variable cost per unit. Step 4, calculate the break-even point. It's the total fixed costs as calculated in step 1 divided by the contribution per unit, which is basically a combination of step 2 and 3. As in step 3, we have to subtract what we calculated in step 2, namely the selling price per unit minus the variable cost per unit. So let's illustrate this by the hand of an example. We are given the following information about the manufacture of and sale of a product. Selling price 1,000 Rand per unit, fixed costs 10,500 Rand, variable costs 700 per unit. Calculate how many units need to produce to break even. So let's go through the steps. Step 1 is the total fixed cost, which is given as 10,500. Step 2 is to determine the variable costs per unit and the selling price per unit. So the selling price per unit is 1,000 Rand, variable cost per unit is 700 Rand. Step 3 is to determine the contribution. Contribution is simply the selling price per unit minus the variable cost per unit determined in step 2. So it's 1,000 minus 700, which results in 300 Rand per unit. And now the final step is to divide the total fixed cost as per step 1 by the contribution per unit as in step 3. So it's the 10,500 divided by the 300, resulting in 35 units. So we need to produce and sell 35 units to break even. So therefore 35 units must be produced to break even.